Right now, the world is drowning in over $300 trillion of debt. That's nearly 3 times the entire global economy. Inflation quietly erodes savings, wealth is concentrated in fewer hands every year, and financial crises seem to repeat faster than ever. Most people think the Islamic prohibition of riba, or interest, is purely a moral or religious rule. But what if the reason goes deeper? And it's not just about faith? Welcome to Eqtsad Global, your global Islamic economy hub. Today we explore why riba is forbidden, focusing on the cold, hard economic reality and exploring the economic logic behind the ban on interest, and why it might be the most modern solution the world has ignored. Money as a tool, not a commodity. First, let's rethink what money actually is. In modern finance, money is treated as a commodity, something you can lend, borrow, or invest to earn guaranteed returns. But money itself does no work. It doesn't produce food, build houses, or generate value on its own. Islamic economics sees money as a medium of exchange, a tool to facilitate trade, not something you can rent for profit. When money is rented out for interest, the financial system creates a synthetic market detached from reality. Example, if you lend $10,000 at 10% interest, the money hasn't done any work. You expect a return without contributing to the economy. This is how finance grows faster than the real economy, inflating bubbles that eventually burst. The risk-sharing paradox. Interest also shifts all risk onto the borrower. Imagine starting a business. If it succeeds, the bank gets paid first. If it fails, the bank still collects interest, and the entrepreneur bears the loss. Economically, this is a zero-sum game. Wealth flows to the lenders, while those creating value carry the risk. Islamic finance replaces this with musharaka and mudaraba, profit and loss sharing partnerships. Both capital provider and entrepreneur share the outcome. Success equals both win, failure equals both lose. This ensures capital is only rewarded when real value is created, making economies more resilient and fair. Interest as an engine of inflation. Interest isn't just unfair, it's inflationary. Through fractional reserve banking, banks create money out of thin air when lending, but loans must be repaid with interest. This creates a mathematical imbalance. More debt exists than actual money. The system requires constant money creation to cover interest. Result, inflation, currency devaluation, rising living costs. By banning interest, Islamic finance anchors money to real assets, preventing endless credit expansion and stabilizing the economy. Wealth concentration and social impact. Interest also fuels extreme wealth inequality. Wealthy lenders earn returns effortlessly. Workers, small business owners, and ordinary people shoulder the risk. Result, economic stagnation, reduced consumer spending, halted social mobility. Islamic finance forces wealth to circulate, investments tied to real activity. Returns earned through productive work supports the wider community. This isn't about charity, it's about systemic fairness and stability. Stability versus spectacle. Modern finance is built on leverage, borrowing to invest at interest. Bubbles form in stocks, real estate, crypto. When they burst, debts remain. Crises repeat. 1929, 2008, 2023. All follow the same pattern. Islamic finance removed the interest engine, making leverage limited and economies naturally more stable. Slower boom, but fewer crashes, real growth, not speculative hype. Money serves the economy, not the other way around. Why it matters today. The world is facing historic levels of debt, inflation, and inequality. Interest-based debt magnifies instability. Interest-free, risk-sharing finance creates resilient, equitable systems. Islamic finance may not eliminate crises, but it reduces systemic fragility and reconnects money to reality. This isn't just theory, it's a blueprint for the next century of global finance, blending ethics, efficiency, and economic logic. Conclusion. So why did Islam ban interest? Not to restrict, but to protect the economy itself. A world where money grows only through trade, risk-sharing, and real production is more stable, fair, and prosperous. Ask yourself, could this ancient principle be the solution the modern world ignored? If you found this perspective eye-opening, subscribe to explore more ways Islamic finance is shaping the future of global economies.